What's going on in the housing market right now? Are people getting loans? What are we dealing with?
We're dealing with everything.
Yeah?
The housing market, well, you know how the housing market's been the last 2 years, maybe more than 2 years now. It's been tough.
Yeah.
I mean,
Tough in what regard? To sell it, to buy
there's
it,
just not
both?
a lot. Yeah, there's not a lot of volume.
Right.
There's not a lot of homes for sale. Inventory is way down. Of course, pricing is up, but the worst part is affordability. You know, interest rates are high. And so when you're in Southern California or even Northern California or all of California and a lot of other places, you know, even a dual income isn't enough. You've got really tough. I was talking with Chris on our way down here, my guy over here, and about buying homes. He's a young couple, and it takes a lot. You know? So big down payments to get affordable payments on it. So, you know, something's got to happen. Rates have been high for way too long. We'll see. We'll see what happens with the new administration.
Yeah, I bought my first house, and I think I was making 90 grand a year. To buy that same house today, you got to be clearing 200.
Yeah.
It's
That's
nuts.
right.
Yeah, it's hard.
That's a big
Okay, so
difference.
something has to change.
Yeah.
Something has to break, meaning prices have to come down, or supply has to be added, or what?
Yeah, I don't think prices are coming down. Again, that's just simple economics. I talk to people about this all the time. I mean, it's just supply and demand. There's a lot more people that want to buy homes than homes that are available.
Right.
And, you know, this really all started in the crash, right? 2007, 8, 9. Housing starts basically stopped entirely. In fact, you saw land that was set for development from big development companies that are no longer around anymore that went belly up. And these went into foreclosure. And those projects were put on the back burners, and cities didn't even get around to approving them. And they sat for more than a decade. And so what would have been inventory feeding a growing population is no longer there. And so that has really backed us up. We're about 7 years away based on current housing starts. And that's, you know, builders filing for permits and things of that nature. So we know what's coming down the pipe. We're 7 years away from having enough housing to feed the population needs. That's the main thing. So I don't think prices are coming down. Now, that doesn't mean prices will continue to increase at the rate that they have. They may more normalize 2%, 3%. I think we saw a bit of that last year. But that's the main thing, is just not enough. That's what's going to keep prices stable. The benefit to lower interest rates is more people can afford property. And so those that are not selling their property because they have a very low interest rate they got in 2020, 2021, and they don't want to get rid of that rate and trade in for a rate that's 3 times that and pay twice a month what they're currently paying for something that is not as nice, that becomes inventory that comes to the market. So I think that really this is all about, can we make it more affordable? Can we lower interest rates? Maybe even enhance some loan products that don't exist today, which is all based on yield curves and that sort of thing, but something that brings the adjustable rates a little bit lower so people can get in at a more affordable price today and be able to afford it later. Your movers up, right? Those people that are employed and expect to make more money in a year or 2 or 3, but need a payment lower today and can afford the higher payment later. So mortgage product will play a little bit into that as well.
Okay, so let's talk about that, because I went through the 2008 bust and I owned a house and I started on an adjustable and then refinanced 2 years from purchase, but it was prior to the crash. And then, with the Big Short, and everybody knows the story, those that were on adjustables got smoked when the bottom fell out. So for people looking at that option today, what do they need to be mindful of? And what are the potential risks, even if they're lower likelihood of happening than, the latter?
All right, so let me unpack that one thing at a time. So first of all,
so let's do this. Let's start with the crash, right? Because something I hear often is real estate is so expensive, it has to crash. Okay, so leading up to 2007, why was the real estate market hot leading up to that moment?
Yeah.
And why is that
easy.
different than today?
Yeah, that's easy. So you brought up The Big Short.
Yeah.
For those of you who don't know, that's a movie. Go watch it. It is very close to real life And I lived it. So I have stories that I can tell you that played exactly into what was depicted there. I wish I was smart enough to know how to short the market back then. We probably wouldn't be sitting here today. We'd be somewhere else. But that being said, look, that was all about greed, honestly. So here's what led up to the crash. And by the way, I could see it coming. So I was a big lender. I was a nationwide lender. We did wholesale, retail. We were the first ones in this market to run 30-minute infomercials. Like, we were big. You may have seen us back then. It was Mortgage Corporation of America. We did under a different name called Zone Funding was our wholesale. That's where brokers sent us business. But the real players in that market were Wall Street.
Right.
They were hungry for mortgage product. They were chopping that up, selling the securities. And when things slowed down, so let's roll back to kind of early 2000s. Adjustable rate mortgages were a big thing. We saw negative amortization mortgages, your pick-a-pays, where you can pay less than what the interest is to really keep it affordable. These were kind of ticking time bombs. But later in that process, what happened was, in order to get like a stated income loan, originally you'd have to put 20% down. You had to have a lot of skin in the game. That was the assurance that borrower was going to make the payments, right? Mm-hmm. When that started to slow down, then Wall Street basically said, how do we get more volume? Okay, well, let's look at lowering our credit criteria. So now instead of a 740 score and 20% down, let's go to 720, or let's go to 700, or let's go to 680. And it started to creep down. And so you started to get to these people that really didn't have the right credit that you would want to lend your money to. And then when that started to slow down, and by the way, that kept going down. I'll circle back to that.
That's right.
Let's do lower down payments. So now it's not 20% down, it's 10% down. Maybe it's 5% down. Maybe they're piggyback loans. We were doing 125% equity lines and that sort of thing, like above. So all of these products were just about greed. How can we bring in more volume of business? That got to the point where we were doing zero down stated income. Okay. Now we're really we're kind of at this pinnacle here where it's like, if the market not even crashes, but levels out, this no longer works. Then we got into the 500 credit scores, bankruptcy yesterday. Like, it was anybody could sign. If they could fog a mirror, they could get a loan. It was that easy. And multiple properties. So 2005, I'm in Chicago. I'm at an MBA conference, Mortgage Bankers Association. And believe me, those parties were decadent, like ridiculous, off the charts, caviar, like the whole thing. We would have meetings during these events to meet with the people we did business with. Because back then it wasn't like video calls and that sort of thing where you can kind of get to know people. So this is like first time meeting somebody in person, seeing what they look like. So I'm just going to tell you this one story because it ties into The Big Short. In a back room, this is, what's that high-end bowling alley called?
Lucky Strike.
No, there's another one. Anyway, I can't. They did just come out.
Bowling's not my thing.
Yeah. Oh, really?
Nice point. No.
Yeah.
Just
we were skating up and down the alleys.
Yeah.
But anyway, it'll come to me. At this high-end bowling alley, big decadent party, but we in the back room we were having kind of private meetings. So this was a meeting with a trader that we were doing business with. This is from Bear Stearns, by the way.
Okay.
They're not around anymore, so I can talk about it. So I'm back there. We start this meeting. The floor manager was there, waiting for the trader that I was selling these mortgages to, these pools of mortgages. Comes in, and he's your typical Wall Street guy that you would picture. He's probably not even 30 yet, slick back hair, overcoat, the whole thing, walks in. We start to chat. We're having a nice chat. And then I bring up and I say, hey, what are we going to do about changing the mortgage product? There's a lot of fraud out there. And we're basically giving loans to anybody. This thing's going to blow up as soon as the market changes. This guy's attitude completely changed. He stood up. He slapped his hands down on the table. He said, if you don't like it, don't do business with us. And he marched out. His manager had to apologize to me for that, but that was the attitude at the time. And so if you watch that movie, this will resonate, but that's what was happening. It was all about greed. So that is quite different than what we have today.
Okay, so this will lead us into today. What happened after 2008, and why did it take us so long to start building again?
It was really about, there was no credit. All your Wall Street companies had gone away. They were the ones that really shored up the market prior to, that doesn't exist today. Fannie Mae, Freddie Mac, Ginnie Mae, they pretty much corner the entire market. The private market is, we don't have stated income anymore, but we have a product like that called non-QM. That's not as big a part of the market. So we lend a much better product today, but it took a long time to get there, because think about Bear Stearns, of course, was one of them. Lehman Brothers, all these giant companies that really controlled the market, they went out of business. Well, nobody wanted to get in and lend money during that time. It was really, really tough. So all you really had for a number of years, like 5-6 years, was you had Fannie Mae and Freddie Mac, and you had FHA and VA. And that's it. Those were the only products, and they really tightened it down. Right. So the quality of that paper in that 5, 6, 7 years-ish post, maybe it was a little longer than that, post-crash, that was the best paper we ever lent. That was the most qualified people you would ever have that bought those homes. So it took a long time to kind of shore up the market again. A lot of things, there was quantitative easing and other things that played into this, but that's what it was.
Okay, so to summarize, demand was created prior to 2007 by allowing people who wouldn't have traditionally qualified for loans to qualify.
Spot on.
So let's call supply where it's at. You increase the demand by allowing more buyers, and now prices run up. Right?
That's right.
Fast forward to today, the regulations are still pretty tight on qualifying for a loan comparatively. But the supply hasn't been added.
Right.
So we have a price increase not because we increased demand, because supply stayed down as our population grew, right?
That's it.
So with all that said, pricing doesn't necessarily have to correct if the interest rates, let's say, stay high. We were talking about insurance yesterday. If insurance comes up, if all of these factors come up, which may reduce a percentage of the buyer pool, but if that buyer pool doesn't drop below supply, in theory, you shouldn't see a correction at all.
Yeah, I'm still a buyer in this market. I'm still buying property. There are fear mongers out there that talk about a crash, and you're going to find contrarians in every market,
like
right? That might be one of them. There might be some others. And that's fine. Look, here's the beauty.
Look, Robert Kiyosaki has been talking about a market crash for 30 years.
Eventually, he'll be right.
Exactly right.
So look, here's the beauty about making predictions like that. If you're wrong, nobody really remembers. If you're right, you boast about it for years.
Yeah.
So that's where you get influencers that go out there just really strong saying, it's going to crash and, causing, this fear. But the reality is the economics don't show that. The economics show that this market is shored up by a lack of supply, and it's a supply demand thing.
Right. Michael's wife sells homes. Is she still seeing that there's a pretty big buyer pool today? I know she sells more high-end stuff.
Yeah, there's a lot of buyers out there, but they're just not ready to pull the trigger with these interest rates.
That's what it is?
Yeah, I mean, everybody's getting priced out. Somebody who 4 years ago was looking at a $2 million house is now looking at like an $800,000 house, right? And then the other problem is that he touched on earlier is the owner of the house that's got a 2.5% mortgage. What will compel them to sell out of a 2.5% mortgage and into an 8% mortgage, right? So the delta is so significant. It's got to come down. I don't know what that number is. Probably mid-4s. I think you'll have a larger pool of people that are willing to walk out of 2.5 and into a 4.5. So that would increase supply into the market in a big way. But right now, it's just, I was walking last night and I called a friend of mine. I walked by her house and she's doing a massive renovation. I was like, when did you buy this house? She's like, 2012. Huge house, 18,000 square foot lot, beautiful home. I was like, how much? $1 million. What's your interest rate on your loan? 2.5.
Yeah.
Why would she ever sell her home?
Yeah, you won't. Yeah, that's right.